Imagine this. You're scrolling through your investment app, watching a stock you've been eyeing drop 10% in a week. Your heart races. You think, this is it, the perfect moment to buy low. So you jump in. But the next day, it drops another 15%. Now you're panicking. Should you sell and cut your losses or wait for it to go back up? Here's the truth. Nobody tells you. The famous advice, buy low, sell high, isn't wisdom. It's a trap. It sounds brilliant, almost like a secret formula for wealth. But what if I told you this simple phrase has caused more investors to lose money than almost any other piece of advice? Stay with me because what I'm about to explain could completely change how you think about investing. Let's break down why buy low, sell high is so dangerous. First, what does it actually mean? It suggests you should buy stocks or investments when their price is at the bottom and sell them when the price reaches the top. Sounds perfect, right? The problem is this. Nobody, and I mean nobody, can consistently predict what low or high actually is until it's already too late. Think of it like this. Imagine you're at a vegetable market and tomato prices have dropped from $2 a pound to $1. You think, great, they're cheap, let me buy a lot. But what if tomorrow they drop to 50 cents? Were they really low when you bought them? Or what if you wait for 50 cents, but prices suddenly jump back to $2 the next day? You miss your chance entirely. Now, apply this to the stock market, but multiply the uncertainty by 100. When a stock drops, is it dropping because it's temporarily undervalued or because the company is actually in serious trouble? When it's rising, is it heading toward a peak, or is this just the beginning of a much bigger climb? The honest answer is, you don't know. Professional fund managers with teams of analysts and millions of dollars in research budgets still get this wrong most of the time. Here's what happens psychologically. When prices are falling, fear takes over. You think, what if it goes lower? I'll wait. So you wait, and the market rebounds without you. You've missed the opportunity. On the flip side, when prices are climbing, greed and FOMO, fear of missing out, kick in. You think, it's going higher, I need to buy now. So you buy at an inflated price right before it crashes. This emotional roller coaster is exactly what buy low, sell high pushes you into. Let me give you two real examples that show why this strategy fails. Example 1, Sarah's story. Sarah is a school teacher in Ohio, earning about $50,000 a year. In early 2020, when COVID hit, the stock market crashed. Major stocks dropped 30–40% in weeks. Sarah heard everyone saying, buy the dip, buy low, but she was terrified. What if it dropped more? What if she lost her savings? So she waited for the real bottom, but that bottom never came in a way she could recognize. By the time she felt comfortable enough to invest 6 months later, the market had already recovered most of its losses. She missed out on massive gains because she was trying to time the perfect low. Example 2, Michael's mistake. Michael works in tech, makes about $80,000 a year. He bought shares of a popular electric car company when they were climbing fast, thinking, this is going high, I need to get in. He bought at $300 per share, convinced it would hit $500, but instead, the stock dropped to $150 within months. He panicked and sold, locking in a 50% loss. Then, a year later, the stock climbed to $400. If he had simply held on with a long-term plan instead of trying to sell high, he would have been fine. These aren't unusual stories. This happens to millions of Americans every single day. The attempt to buy low and sell high turns investing into gambling, where emotions and guesswork replace strategy. So why does this matter to you personally? Because how you invest affects your entire financial future. When you're constantly trying to time the market, you're not investing, you're speculating. And speculation leads to stress, poor decisions, and usually significant losses. For regular people, people with jobs, families, and bills to pay, your investment strategy should support your long long-term goals like retirement, buying a home, or your children's education. When you fall into the buy low, sell high trap, you put all of that at risk. You start making emotional decisions based on daily price swings instead of sticking to a solid, disciplined plan. Your savings, your future security, everything becomes unstable. Meanwhile, the investors who succeed, the ones who actually build wealth over time, they're not trying to outsmart the market. They're playing the long game, and that's what we need to understand. So, if buy low, sell high doesn't work, what does? Let me introduce you to 3 powerful concepts that actually build wealth. First, dollar cost averaging. This is a fancy term for a simple idea. Invest a fixed amount of money at regular intervals, no matter what the market is doing. Let's say you decide to invest $200 every month into a diversified index fund. Some months prices are high, so you buy fewer shares. Other months prices are low, so you buy more shares. Over time, this averages out your cost and removes emotion from the equation. You're not trying to time anything, you're just consistently building your investment. Second, diversification. Don't put all your money into one stock or one sector. Spread it across different types of investments: stocks, bonds, real estate funds, international markets. This way, if one area drops, others can balance it out. It's like not putting all your eggs in one basket. This protects you from the wild swings that make market timing so dangerous. Third, long-term thinking. The stock market historically goes up over long periods, 10, 20, 30 years. Yes, there are crashes and dips along the way, but if you stay invested and don't panic sell during downturns, you capture that overall growth. Warren Buffett, one of the most successful investors ever, says his favorite holding period is forever. He's not trying to buy low and sell high. He's buying quality and holding through all the ups and downs. Let's recap. The advice to buy low, sell high sounds smart, but it's actually a psychological trap that leads to emotional decisions, missed opportunities, and underperformance. Nobody can consistently predict market bottoms or tops, not even the professionals. Instead, focus on consistent investing through dollar cost averaging, protect yourself with diversification, and commit to a long-term strategy that removes emotion from your decisions. Here's my final thought. Wealth isn't built by being the smartest person in the room or having perfect timing. It's built by being disciplined, patient, and consistent. Stop chasing the illusion of perfect entry and exit points. Start building a strategy you can stick with for decades. That's how real wealth is created. That's how you win.